Good afternoon, everybody. My name is Stephanie Baxter. I am the Director of Programming and Engagement at the New Hampshire Tech Alliance. For those who aren't familiar with the Alliance, we are a technology association in New Hampshire and are dedicated to growing and thriving the tech industry in New Hampshire. We have a lot of different programs and initiatives that we take hold of to try and do that through workforce, our Tech Women, Tech Girls initiatives, and a lot of our startup programming, which is what we're here for today. We have announced some new startup programming in 2022, and one of those items is a resource guide on our website for startups that are looking to grow and scale their companies in New Hampshire. There's quite a few resources in all different areas, from co-working spaces to financing, business advising, lots of different options, different places to point you in the right direction for any help that you need. We also launched office hours for startups, where startups can schedule 30-minute appointments with subject matter experts monthly, and those are the last Thursday of each month from 2 to 4. So we encourage you to take advantage of those. We have a lot of experts who are volunteering their time and willing to chat and provide some help and some guidance. And then webinars like this. So this is Startup Funding Explained. This is the third part of a 3-part series, which is sponsored by Cook Little. And the first 2 are recorded on our YouTube channel and on our website, which is nhtechalliance.org. The first one looked at the different types of funding that are available to startups. The second webinar looked at how to perfect your pitch. And today we'll hear from some founders about how they have used funding to grow and scale their businesses. So just a few logistics. We do have a chat if you'd like to chat during the event. And then up above, you'll see there's also a Q&A tab. We just ask you put your questions in the Q&A tab, and we'll address those as the event goes on. And yeah, I think that was it for logistics. And again, we want to thank Cook Little for sponsoring this webinar. As a nonprofit, we can't do the work we do and the programs we have without our sponsors and our members. So a big thank you to Cook Little. The content we've been having for this series has been amazing and will be super helpful to startups as they go along their journey. So I would now like to introduce Matt Benson from Cook Little, who is not only a corporate attorney and partner at Cook Little, he is a board member at the Alliance and a huge supporter of us. So welcome, Matt.
All right, thanks, Stephanie. That's great. So this, as Stephanie was alluding to, this is kind of the culmination of a 3-part series. We've talked in the prior segments around expectations around raising capital, sources of capital, and related topics. And now we're here to talk about, let's assume you've gotten the capital. How do you want to deploy it most strategically, and how do you want to leverage it as best you can? We've got a great panel to kind of go through that from their own and different perspectives. And what I'm going to ask each of them to do, starting with Paul, is just a quick introduction about who each of them is, and then we will go from there. So, Paul.
Great. Thanks, Matt. And hello, everyone. My name is Paul Mailhot. I'm the Chief Operating Officer for Beg Network. We're a cloud-based networking platform that securely connects people, places, clouds, and devices located anywhere in the world. We're a relatively young startup based out in Nashua. It's good to be here. Thanks, Matt.
Great. Jeromy, how about you?
Hi, my name is Jeromy Grimmett. I'm CEO of Rogue Space Systems, and we design and engineer space robots to deliver in-space services such as inspection, debris removal, and other various commercial and defense applications.
Awesome. And Carla.
Hey everyone, I'm Carla Vanderhoof. So I'm the co-founder and chief design officer of Propensity.com, formerly Addapptation. And we help B2B organizations find their 5% of in-market accounts. At any given time, only 5% of your total addressable market is in market for your product or service. And we help surface that up with intent data and other data that we aggregate and track signals. So you can always have your growth team reach out at the right time and be there when your buyers are ready to buy.
Awesome. Well, very good. Well, thanks, everybody. Again, a great panel. They all have different perspectives that they wanted to kind of bring to the table here and talk about how they would suggest might be some effective ways to deploy the capital that startup companies have been able to raise. So maybe starting with the first question, kind of in that order, same order with Paul and then Jeromy and then Carla. I'd like to ask how you prioritize.
I think he froze up.
Uh-oh.
I'm not sure if he was going to ask how do you prioritize what funding to go get, or how to spend your money. And I'm starting to think it's spend your money. So, Paul, how do you go about that?
Yeah, I think that's a good assumption. We'll go with that while we wait for Matt to come back. But the way we're prioritizing our resources, the capital that we've raised right now, is primarily around software development. So we're still working through the development process. I'd say we've got a really strong product set at the moment, and we've started to use a customer beta program to test that software out with and the devices out with in the field. And that's where, the priority's been for us these last couple of years, really over the last year. And now we're starting to add a little bit of operational work to the business. So that's some of the things that I'm involved in. I'm sure we'll talk about those over the course of our conversation. And then as we start to go out to market, we'll start to use some of that capital for sales and marketing type activities.
Carla, I think it'd be good for you to jump in here, because my answer is going to be similar to Paul's, but not exactly. I prioritize my stuff a little bit differently, but I think I would fall in between the two of you. That's my guess. But go ahead, Carla. What are you thinking?
Yeah, and it's interesting when you look at like which stage of funding round you're getting to, because both of you guys have primarily like product focus. You need that investment to put toward the product that you're developing and building, right? So we're an interesting case because we did have the services side as well. So when we founded, we had both a technology building in, and when I said we were formerly Addapptation in our low code platform, but we also had customers that we had a services model too. So we were able to bootstrap up while we built our product, and while we built our product with actual, customers giving us feedback. So it was a nice model, especially in the early days, to de-risk a lot. So when I look at, the pre-seed versus seed funding and how we prioritized our capital for those different phases, I would say it's slightly different. In the early days, it's really like helping stand up the people, I heard one person once call it like the right butts in the seats, right? So because you have to have those people in the early days that are really going to help you get that vision to reality. And then once you have that message market fit, now you're ready to deploy the capital toward growth, which is more where we're at right now. So message market fit, product market fit, what's working with capital, and then you can double down for those growth efforts.
So Carla, whenever you said right person, it's called RPRS. And that's from Entrepreneurial Operating System. That's an actual program. I don't know if you ever heard of it, but it's called RPRS. It's called Right Person, Right Seat. And it has to do with an additional acronym called GWC. Get it, want it, capacity to do it. So does the person get what the job is? Do they want the actual job?
Right.
And do they have the capacity in terms of knowledge and time to execute the position that they're actually taking? And that is dovetailed up with the values that you're trying to institute within the organization, so that you have the right person, the right seat, in terms of both executing the position and the responsibilities, but also the cultural fit for the values.
Yeah, and it's
I have to share
specifically
because
super
yes,
important in those. Oops, sorry, specifically super important in those early days too, right? Because one person makes such an impact for your company. So there's an element of luck too. I think luck should be in there, finding the right people.
yeah.
Hey,
So
Stephanie.
in our as far as Rogue and our prioritization, whenever we first started during our pre-seed, they one of the mistakes that I had made in my previous company, my previous startup, is I went so heavy on engineers, I didn't do pretty much anything else. I didn't do operations, I didn't do sales marketing. I just went engineers, engineers, engineers. And as a result, that was a huge mistake. It was just a massive mistake because then I no longer had the revenue generation or the operational support, and that dragged everything down. So there's got to be a balance that you create. This time around, it was completely different. The very first person that I hired was actually a sales marketing person. That was the first person that I hired. And then the second person I hired was an engineer. In terms of operational support, I outsourced everything. I outsourced the bookkeeping, I outsourced the accounting, I outsourced the HR, I just went on an outsource spree because we needed the infrastructure in place because I knew I was going to have to scale, but I didn't even bother trying to go and hire anybody for those positions. So
Mhm.
between myself and my executive assistant, we were able to manage the entire business just simply by outsourcing those key components. QuickBooks Online, QuickBooks Payroll, quick, easy, down, dirty, get it done, no problems. So QuickBooks, Bambi, supporting strategies, and Lally and Company, and of course you get your lawyers. But that's how I did it this time around, and we've been kind of keeping it pretty balanced between operational support and engineers obviously outpacing that. But all in all, that's how we prioritized it because research and development, as what Paul was saying, and you even said that was the priority because
Yeah.
that's kind of our business for the moment.
It also wraps back to risk, right? And risk mitigation in the early days, because that's such a critical piece of, early funding, especially. Welcome back, Matt.
Yes, thank you for having me, and thanks for carrying the torch, everybody. So maybe the discussion is better with me not here because you guys are doing it. So one of the things I also wanted to make sure that we talk about is the distinguishing factors between some of your businesses and what restrictions you may have, if any, on how you deploy funds that you have. Are there any rules that you need to follow, imposed by others? And then secondly to that is how do you kind of maybe impose your own rules? And how does your business strategy then dictate some of what Jeromy was talking about, in terms of how you prioritize and what you want with the funding that you've got. So maybe we could start with the first question, which is based on how you've raised your capital and where it's come from, what restrictions or rules are imposed on how you deploy the. You want to start with that one? I think that might be most relevant to you.
Yeah. So everything. So we deal primarily with United States Space Force, DoD, and government customers because the commercial space industry, in terms of the services we're looking to provide, has not matured yet. So the commercial markets hasn't quite caught up. So we deal primarily with defense. So any of the money that we get from the government, we've got to account for in very specific ways. There's government accounting rules. There's all kinds of things that the accountants and bookkeepers have to do to make sure that we're basically not blowing their cash that they give us. So I think if there's any one big piece of advice I could give to anyone that's going to be doing anything with government is make sure you get yourself a bookkeeping and accounting firm that has familiarity with how to deal with government grants and project based accounting. And do yourself a favor and set up your books, your book of accounts inside of QuickBooks. Do it at the very beginning and stick to it, because if you don't have that organized from day one, you're missing out on all kinds of data that is important to you. Take the government, set that to the side. You're just talking about yourself and seeing where that money is going within that business, and we can get very granular inside the business. I can go open my books right now and I can see where every nickel is going anywhere inside that business in very minute detail, in terms of cost centers and things like that. Set that stuff up as early as you can, and that way you can really track where your P&L is, and make sure your balance sheet is lined out appropriately, and have a solid, reliable bookkeeping and accounting firm that can keep those books updated at a minimum of weekly, because you will be really surprised at how quickly you just start burning through cash and the rate at which those expenses start accelerating over time. So that's my piece of advice. So it looks like Matt dropped again. So
Poor Matt, he's having a hard time.
I can go next, because I was
go
thinking,
ahead, Carla, and then I can chime in. Go ahead.
It's interesting with the government sort of funding framework there, where you could say there are literal restrictions and guidelines and don't cross this. For us, we've had more VC angels and family offices, so it's not so much restrictions as it is accountabilities, right? You now have a team of people who are invested in you and your company, and there's a communication and an accountability, and you can't just overnight spring things on people. So that was interesting for us, because when we funded our most recent round, we were Addapptation, knowing that we were going to be moving toward propensity. So we had full communication, and they were all on board with that movement. But that's really important. And I think that's really important too, when you're thinking of raising money, is finding the investors and board members that are going to support you through those decisions. And I think that's a very important piece in the whole fundraising kind of philosophy. It's you really need to find people that understand and a level of trust in the founders, right? A lot of our investors say, especially at the early stage, well, hey, we are investing in you guys, right? Because we know that you're going to be the team to solve problems, and you're going to build the team that can solve problems. So I would change the word, coming from the VC side, from restrictions to more of accountabilities and responsibilities, right? As the founding team and founders.
Yeah. Just to tag on to some of those things, Carla, I think that's well said. Some of my experiences, not only where I currently am, but previous experiences. So I worked at Dine, and as I joined Dine, we were just beginning to take on outside funding through VCs. And accountability is a great word, but I think we were quickly introduced to governance and having a board that helped shape priorities, strategy, where we deploy dollars, etc. So there's certainly, again, I don't think I'd use the word restriction, but more accountability and even governance might be the better word. I then went on to a manufacturing institute that was government funded. So I can certainly relate to some of the things Jeromy was speaking to. And I think those are spot on. I think getting a financial person, systems in place that understands project-based accounting, super, super important. And now at Big Network, we're currently funded primarily by 2 individuals. It's relatively easy. They're on the board, and it's relatively easy to drive that accountability across the business and get that direction. We're still a small startup with only 2 investors, so that accountability and that governance, if you will, is pretty much happens in real time, day to day.
The only thing I would add to that is we also, so in terms of restrictions, like anything that we do, we're not allowed to. This is more like a self-imposed restriction to avoid other potential problems. So we cannot outsource a lot of the engineering that we do. We can't outsource it to a foreign company, a foreign owner, or excuse me, a foreign person, because we're under ITAR and export controls. Everything in space is a weapon, period. It's like end of sentence. If it goes to space, it's a weapon, falls under the ITAR, falls under export control, end of sentence, right? That's it. So we cannot send information. We're restricted to sending a very tight swath of information outside the country, and then, but any country can send us whatever they want, all the detail they want, but we're restricted to a very, very thin line of what information we can send out. So to that end, the use of funds has to be disclosed on who you're paying to perform work. So there are declarations inside the SBIRs, STTRs, and any government contracts that require you to disclose any foreign persons. So a self-imposed restriction that we put in place is that we cannot hire anyone that is not a U.S. person because of national security related stuff that we're involved with. And to that end, that immediately shrinks a lot of people that we're able to get access to. So that's one thing to be aware of. Also, foreign ownership in your business, that requires a CFIUS approval. So any type of foreign investment that you bring in, you got to make sure that you've done your due diligence on the VC or individual, that foreign money, that foreign money source, so that you can make sure and get through the CFIUS process without any issues. But yeah, putting in governance and accountability from day one, that certainly helped us.
Great. So I'm just going to pop in here. Matt's having some connectivity issues. So wanted to talk a little bit about the financial planning and how often does it change? Do the models change? How has your experience been with that? I know, Jeromy, I know you have quite a bit to say about that, but as you go through all of that, for all of you, it'd be great to hear how fluid that is and how it changes or doesn't change. That'd be great.
I'll jump in on that real quick. I think, in short, I think it changes as often as your strategy changes as a business, right? And as a relatively early stage business, and as we bring our product out in front of customers and get feedback, that certainly is driving us to look at features a little bit differently, shifting maybe the pricing and packaging strategy that we initially set up for the business to change a bit. So I think as an early, speaking as a relatively early stage company right now, I think it can change a lot. The other thing I would offer is there's also the need for some discipline, right? And to stay focused and to make sure you're not changing strategy just because you've heard it, you've heard a request from one customer as an example. So being flexible, but at the same time being focused on what you believe your business needs to be successful is, it's been my experience, very, very important.
I agree with that 100%. So as your strategy change, you're always going to reevaluate your capital, your runway, your goals in order to meet them. I've always sort of believed in being a little more cautious. I guess we're cautious, whereas I've seen other founders burn things a little quicker, right? Everyone has their own risk tolerance. But we've always kind of taken the philosophy around spend money when you are pretty darn sure that the money is going to return with the end results that you're putting it toward, if that makes sense. So like, if you know that marketing to this audience will put that return, then you double down, triple down. But until you have those signals and know that something is repeatable, be cautious overspending in areas to figure things out. And I think that's something that, as I've seen other startups and grow and looked at their models, a lot of times people will deploy capital to figure things out. And I think that that's a risk point. So always matching that strategy and having milestones for when you're going to deploy the capital that you've raised, I think is a really smart plan. And I completely hear you about, Paul, about not overly shifting the strategy based on customer feedback or even board member feedback, right? Because ultimately, your model the best, your business the best. And there's a lot of advice in the world, and that advice has been formed based on their experiences. But you can have two people saying that have had really, really lots of experiences, help lots of companies. They can give you opposite advice. So to overcommit to advice or shifting strategies too much, then you end up kind of losing instead of having that focus.
Am I back? So again, apologize for the disruptions. I'm going to keep Stephanie here on the sidelines to step in when or if I freeze up again. But wanted to see if you could each just chat about how your strategy has evolved as your business has evolved. So maybe Carla, you could talk about that from when you first started the company, deployed capital, raised some money. How did you focus on what you wanted to do there to get to the next step, and then more recently?
Yeah, so I know I had mentioned that we had the services component. So raising the capital really helped us be able to hire people to offset, the founder skills. So, and that's always different based on what skill sets the founders come in with, the team that you need to hire. So we had the services component, so we did have some revenue coming in. We did raise like pre-seed, and that helped us with our, I guess, just mitigate some risk for us. So we felt comfortable taking chances on people, or if we needed technologies to purchase. It just made us feel a little more comfortable taking those steps forward. As we have grown, as we have been able to build our product, as we have validation, now our funding is more toward growth. So that kind of gets back to what I was saying, Like once your strategy starts shifting to, okay, we have some level of repeatability around our audience, around our marketing, around our sales. Now we can use that funding to push into growth, to really ramp up our scalability, our growth, and bottom line revenue.
And I know that you have different experiences too with some of your prior lives. So maybe there's some relevant tips there as well. But as these companies have evolved, how have you seen the strategy and the use of funds change?
Yeah, certainly. Thanks, Matt. I think, going back to my experiences at Dine, as I mentioned earlier, I joined the business when we were just starting to get some outside funding. Up until that point, we were running a very profitable business that was bootstrapped. I mean, hats off to the founders and to the team that was there before me. The business was running great. But what that capital that came in at that point and then onward helped us do is really fuel the growth. I mean, we were able to really accelerate our hiring. We were able to accelerate our go-to-market plans and hire a really great sales and marketing team that helped really propel the business forward and ultimately to its acquisition by Oracle. I compare that against, where we are today. And again, as I've mentioned, we've been primarily using our capital to fund development. And now over the last, I'd say, 30 to 60 days, we've really been focused on getting a beta program in place. We're starting to work directly with customers who are utilizing the technology, giving us great feedback. And we can start to see that shift to monetizing that product placement. And we're starting to think about, okay, what are we now going to be able to do from a sales and marketing standpoint, specifically sales, to help follow up with some of these opportunities and ultimately monetize those.
Yeah, great. How about you, Jeromy? I know that when we've chatted before, you talked about your financial plan changing readily.
Yeah.
How has that kind of then been taken into account and changed your strategy about deploying your funds?
Well, again, we've been pretty fortunate that we already had pretty clear line of sight on what we had to go and execute and stay focused on. And I think I said this whenever we talked, we really have not. It's not uncommon for a startup to pivot, right? It's not uncommon for that to happen. However, because we had implemented the entrepreneurial operating system very early on, probably just over a year after starting, we were able to maintain our focus and allow that to really drive our priorities. And we didn't pivot as much as we refined and we honed what we were working on. And that has really solidified the path and our spending. Now, what I was talking about in terms of the model changes damn near every day, it's because, so a perfect example today, we went over spending for the week, and instead of spending what I thought was only going to be maybe, $5,000 or $6,000 on legal bills this week, it turned into 15 because, the FCC had some rule changes, and now we got to bring in 2 RF spectrum attorneys and pay retainers for those guys along with their consultants. So we had to move stuff around because we're focused on getting our programs into space in November. So
what I'm hearing, Jeromy, is prioritize payments to lawyers. Is that what I heard?
dude, I'm so sick of paying lawyers. You have no idea. No, in all seriousness, Rogue has 8 lawyers. Like, we have 8 lawyers covering everything from national security, government and regulatory affairs, corporate securities law, general counsel, ITAR export controls. Dude, you have no idea my legal bills.
So your compliance costs, I think, are higher than what Paul and Carla probably see because of the nature of your business. And that's got to be something that you just have to spend on, right? If for no other reason, then you got to stay between the rails on the business you're in.
There's a lot of CYA in this, and that is one thing we do not risk. Like, we do not risk any being out of bounds on anything. There's no, like, man, every single NDA gets reviewed prior to signature. It doesn't matter it doesn't matter what that NDA is about. It doesn't matter. It all gets reviewed. Every piece of paper that comes across us gets reviewed in some kind of way.
So let me ask the question, kind of the flip side, right? We've talked just now about what you spend money on and what some of the priorities are. Are there things you've spent money on that you wish you hadn't? Not that you didn't have to, right? You all spend money on things you have to spend money on that you wish you didn't have to spend money on. But what I'm talking about is kind of lessons learned, things that you've invested in or done where you say, I could get that cash back and deploy it. Sounds, Jeromy, like you've got something.
Oh, I got a list. I mean, I could give a master class on what not to spend on. Okay. So, number 1, don't bother spending money on office furniture. That is the stupidest thing ever. Don't do it. Go to Walmart, buy some $30 fold-out tables, go to Goodwill, go to Salvation Army, go to those places and equip your office. Period, point blank. Don't even bother spending on that garbage because you don't have money or time for it. You can put your money towards something else. I'm still working off of fold-out tables in our office right now. Okay, nobody complains, nobody cares. And whenever VCs and investors come in, they see it. And they're like, okay, these guys are not messing around. They're not here for image. They're here to get stuff done. So that's one thing. This is very, what I'm going to say is very controversial. Don't waste your time on intellectual property right now. Don't even bother spending the time on it.
Just a point of clarification, Jeromy, when you say intellectual property, do you mean patents specifically, or are you talking about, okay. Yep. Because I just want to make sure, just for the audience, we're not necessarily talking about confidentiality agreements to protect trade secrets, and we're not talking about some others.
Get your NDA and get strong mutual NDAs in place. Don't bother sending the NDA to the VC. They're not going to sign it, period. They're just not going to do it. Not until you're at least on the 3rd or 4th call doing tech due diligence. But don't even spend the time on trying to get patents, trying to write patents, trying to do a bunch of IP protection on that. There's just no point. Just shut the hell up. Don't put your stuff out there. Market is confidential and keep it in-house, period. Whenever you have the money, whenever you get a nice big investment of several $1 million, and then you can allocate an entire budget to do that, that's when you go and do it. Because right now, if I go into Rogue's systems in the protected areas, if I go into Rogue systems, no joke, we have a minimum of like 50 different things we have to go patent.
Yeah.
Do you know what that, I mean, that bill would be massive. No startup can handle that. Just don't spend your time. So those are my 2 pieces. Office furniture and IP.
And patents. All right. Carla, what are your thoughts? Are there things that you guys spent money on that you wish you could reel back and redeploy?
I mean, as a I totally disagree with the office. I think we all were like, "Ooh, pandemic! Everything's remote now. Awesome! So glad we." That changed things, right? So, hindsight is always 2020. For like, well, maybe we didn't need the beautiful office furniture that we moved into 3 weeks before the pandemic, but I will say I'm glad we have it because we do have VCs and customers here a lot. But I think we have been very cautious about and always linking to strategies, right? So I think when you're funding and the capital is spent on strategies, you're gonna win some, lose some. So I don't have any regrets. The one thing I would say in maybe the earlier days is more around team building. And I think, Jeromy, you said it really well, how you outsourced certain things. I think you can be really smart about that. Instead of investing in too big of a team, you can be selective on the things that you need. And if you have really good planning and strategy, you can kind of fill those gaps in a smart way to get further ahead without over investing in people like early. And then, of course, the balance is, but then you do need to develop people and have your team. But I think just thinking the really, really early days, I don't really have any regrets on our spending, but how we handle it now is a little different than, before we knew.
Sure. Yeah, no, of course, right? The circumstances certainly have changed. Paul, how about you from your different experiences?
Yeah, I mean, certainly here, again, early stage company. I 100% agree with what Jeromy said earlier around outsourcing, right? That was something that the business spent some money on early on. As we now are starting to grow and add people, look at my role, for example, very operational. We don't need to invest in as many of those outsourced services. And I think that the big takeaway here for me and the thing I'd want to share the most is think of those outsourced services as similar to all the subscriptions that you've been purchasing through the pandemic, right? Whether, all the streaming services and music services, one of them is not that much money. But if you start stacking up 8 or 9 or 10 of them, all of a sudden you've got a $300 or $400 or $500 a month bill. It's no different on the outsourced services side. And as we look at our business and we try to be really smart about where all of our dollars are going, we're starting to pull the threads on a couple of these services, thinking, okay, well, we don't need this, we don't need that. Maybe we needed that once upon a time, but we don't need that now. And I think it's really easy to start adding those outside services, especially when they're only billing you $25 a month or $30 a month or $80 a month. Now all of a sudden you've got a burn of thousands of dollars a month in outside services, and you may not need them all. So something to just be, again, I agree with Jeromy on the need for those services, especially early on, but those can multiply and add up really quick.
Doing a consistent review of those services on an ongoing basis to make sure that you're not overspending in those areas. That's something that we did institute, and it has paid dividends for us, but it's also paid dividends in identifying the services that we should possibly turn the dial up on a little bit. Mm-hmm. And that prevents, so I would say combined up with all the services that we have, we could probably pay one full-time person maybe at this point. But the amount of time, energy, and savings that we get, because it would require so many different people across a broad set of skills, it just makes financial sense right now. It may change later, but right now that's what it is. And I'd also encourage people to really look at the position that you need and see whether or not you need someone full-time or if you just need them for a few hours a week. If you just need that person for a few hours a week, go to Upwork.com, find what you need, and rent that guy, And you'd be surprised at how many people we recruited right off of Upwork.com that's still in our business today.
The other thing I would add about the outsourcing is sometimes in the short term, it's actually more expensive because like say you go with an outsourced firm for something, but you get a bigger team of expertise and you can run more tests. So it might be more expensive up front, but because it's maybe month to month or whatnot, you can get those tests run and then you can hire someone once it's been validated. And I think that's a really good model too, and just something that you kind of have to keep your eye on, because you could say, hey, we could have a full-time employee here, but you might not get as much tested in a shorter timeline for validation. So that's something else that along those outsourced lines and team building lines and deployment of capital to consider.
So I think that segues into kind of another issue. You know, we've talked money on maybe what to avoid. We've nibbled around the edges on, I guess I would call it alignment with your investors. Have any of you experienced, I think, Carla, you alluded to some of this in some of your comments when you said you don't want to pivot just because your investors are telling you to pivot or your board is saying do this or do that. You might want to take it into consideration and figure out how to address it. But what have you found in your experiences regarding alignment with investors, whether or not the action that's been created, how your investors have been partners in figuring out how to deploy funds, how they view you as a good steward of the investment that they've made, and how you've been able to kind of work your way through any issues that have come up. So, Carla, do you have any feedback on that?
Yeah, and as you raise more rounds, that pool gets bigger, right? So, I think a big piece is communication, right? Because your investors and your board don't want to just see all of a sudden decisions made without understanding the thought process around it. And pivots, maybe even focus points, Jeromy, like you said earlier, we haven't pivoted, but we've hyper focused in a certain area. That is going to happen as a startup. It's like, oh, I thought we were over here, but now we're over here. So, you know, whether you write a monthly investor note or a quarterly investor note, really being thoughtful on those updates and keeping everyone in the loop as to why you are making the decisions you're making, I think is really, really important. And it gets back to also, you know, who invests in you. So if you have those open lines of communication, if you have a level of some level of trust built, like we know we're not just going to all of a sudden say, hey, we were in B2B yesterday, but we're in B2C today, you know, like it isn't that big of a jump. And then also, as Paul mentioned earlier, as you raise and you have boards established, you have those board meetings as well. So keeping the communication open and honest there, having the strategies laid out and why the company is moving in the direction it's moving, why funds are being spent, where they're being spent, and the goals and the ROI that you want on the other side of that desired outcome is really, really important.
Jeromy, what are your thoughts?
This time around, in terms of Rogue, we came from outside of the space industry, like totally, completely outside of it. Okay. So we're brand new to the industry. Credibility was essential because we had no experience in the industry. So what we did know how to do is we knew how to operate a business. We knew how to do market discovery. We knew how to build relationships. We knew all of those things, but we didn't have the technical expertise. So what we set out from the very beginning to do is build up the credibility in the business, meaning our books are tight. We have reviewed financials. we're constantly on top of maintaining all of our legal things. We're executing to plan as best as we can. And as a result of demonstrating that ability, VCs turned around and actually started to invest in us because they saw that we weren't just a group of nerds with a widget that we're trying to go create a market for. We actually identified the market, and then we started to build the team to develop the technology to support the gaps that were out there so that we could then deliver that service. Okay, so we went in a very different we did this in a very different way as compared to most space startups, and as a result, our experience is my VCs don't call me. I mean, they don't call us. They don't ask us for nothing. They don't. I mean, we call them and talk. We initiate communication far more than they call us. They don't tell us what to spend, what not to spend. They don't, nothing. I mean, if there's a conversation, it's because we called them or we emailed them. It's credibility, in my opinion. I mean, you build up, if you can show people you know how to build and execute a business, VCs don't care. They know that they've got a solid investment in you.
So, Paul, what have you seen in your experiences in terms of that alignment, potential friction with investors, and how to address it if it's come up?
Yeah, I think the key, as I'm hearing the conversation, I think the key is even before any money is sent, there has to be a discussion, a set of discussions, and almost like an interview, if you will. It's kind of like applying and interviewing for a job, right? The company's interviewing you as the candidate, and the candidate hopefully is interviewing the company. And we keep talking about this word alignment, so important. I wrote down trust. I wrote down good fit. I wrote down ability to communicate both ways. And I agree with Jeromy, credibility, right? Is the source of the funding credible? And, what are you and your team doing to show your credibility to the investors? And in the cases that I've been involved in with outside funding, both here and in other spots, I think there are times when the fit's been great and the communication's great, the trust is great, it's a good working relationship. But in the cases where maybe it hasn't been so good, you wonder if that proper conversation was had, that interview was had before the check was written. Did that occur? And my guess is it probably didn't.
Yep. No, excellent. Yeah, start early, right? You got to look down the road, but you can't wait too long to have those discussions. Make sure things are addressed early and consistently, right, throughout the relationship. We've only got a few minutes left, and I wanted to make sure you each had an opportunity, as you kind of sum up thoughts, to throw out there what you think your primary tip would be, maybe to your younger self as you were starting off. If you knew then what you know, what's the one or two, maybe three things you would tell yourself to really focus on in the deployment of capital that you raise, so that you feel as though you're being a good steward of the money that's been invested and you're deploying it well? So, Jeromy, do you have some thoughts on that?
In terms of use of funds, it's highly circumstantial. As a prerequisite, do everything you can to understand what you are going to be focused on. What is that deliverable that you are trying? Set your milestones up as best as you can. Humans are horrible predictors of future. Okay. So on line of sight, look at what you're trying to execute in 3 months, in this one quarter, and then prioritize that money spending around 3 to 5 milestones in that quarter and execute to plan. Over the course of that quarter, you can identify, do I need a full-time person? Do I need a part-time person to support the execution of those milestones? Once that quarter is over, you can flip the switch and say, okay, I do need a person full-time to execute this, and I only need somebody 2 hours a week or 10 hours a week or whatever to support the rest of this. And that way you're minimizing your spend, you're prioritizing it. And if you set it all up and it's properly accounted for and book kept, then you're going to be able to deliver those reports and deliver that information to a VC and demonstrate, hey, this guy actually, these people knows, they know what they're doing, that and office furniture. Just stay away. Stay away
So I hope you're not sponsored by any office furniture companies today.
I hope not, because I did a very poor job of that.
If we were, maybe no longer.
Yeah.
Anyway, Carla, what are your thoughts?
So some of the similar things that we've been revolving around, I think, have really clear milestones as to when you're going to spend your capital, and don't overspend on discovery. When you can outsource something, outsource it instead of, overbuilding internally, because that's a really good way to both move quickly. And also, you don't want to have to hire and then be like, oops. You don't want to, I don't know, that's a really hard thing both ways, right? For employees and as the employer. So I feel as though it helps when you can outsource things, the people that you do hire internally, you have validated that role is needed. And that's really a very solid piece of advice if I could tell myself, back then. And then the other one is building strong relationships with your investors, which is something, fortunately, we've always done. But I would also say stay in touch with them, because when you look at future funding rounds, you want to have relationships built, even if someone isn't invested in your company. Just staying in those circles, staying in the conversations, because part of deploying capital is, seeing an end of the runway and understanding when you need to raise again, and being on top of market trends, understanding like, hey, is a recession happening? Is inflation going to mess up my runway? Those things are all really important to stay on top of and to understand, because, part of it and part of fundraising is luck. So you want to stack your cards in your favor to stay on top of like when your product or offering is hot in the market, when people are interested in investing in your particular product. And I would say that that's a very important thing as well.
Great. Paul.
Yeah, I guess just to tag on that a bit, I referred to this earlier, but as we start to work with customers, bring our product out into the field and collect feedback, I go back to what I said earlier, you're going to need some discipline to ensure that whatever you decide to do moving forward is scalable and it's sellable. No one's going to be shy about what they wish the product had. And those one-offs are going to cost a lot of money, and they're going to take a lot of time, and making sure you're sticking to your plan and focused and serving the largest set of customers that you possibly can down the road, I think is going to serve you well.
And if I could throw in one other tip based on my experience today, make sure you invest in a good Wi-Fi network. So I think we're about out of time. So I appreciate very much all of the feedback, all of the thoughts, and tips for hopefully those that are listening and can take to heart and hopefully avoid some of the mistakes you've made and take advantage of some of the things you've done right. And I'll turn it back over to Stephanie for some kind of final parting word. Thanks everybody again.
Great. Yeah. Thank you all. This was really wonderful. And again, this is the third part in a 3-part series. So you can find the first 2 parts on our website, which is just nhtechalliance.org, or our YouTube channel. And I invite you to check out the website for all the different resources we have for startups, from the resource guide, office hours, different webinars like this, and then also our Speed Venture Summit will be coming up in September for New Hampshire startups. It's basically speed dating with investors. It's a great way to get introductions and get exposed to investors in the New Hampshire area. So head on over to our website, check it out, check out all these recordings, and if there's any way we can help, please let us know. So thank you, everybody.
Great. Thanks again, everybody.